Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, October 12th. We got a couple economic news releases to go over today. We'll start off with the weekly jobless claims. So last week we had 260,000 people apply for unemployment. They're supposed to kind of stay in line about 258, and it came way down to 243,000. Now that's pretty good when you factor that after the hurricanes, we went up to 298,000 people applying for unemployment. And then since it's kind of dwindled its way down, and over approximately about a month, we've dropped about 50,000 people from going. We're getting back to the normal in the 230 range. And again, this will probably improve again coming in November when we have the seasonal workers for for the holidays, when they hire a bunch more. And speaking of such, Amazon announced today they're going to hire like 120,000 seasonal workers over the holidays. Now, again, this is just kind of showing the resiliency of our job market right now. We're showing pretty a lot of strength in our job market here right now. Last but not least, we got the producer price index. This is kind of an index that gauges the inflation level on the wholesale side of things. Now, it's something we kind of look at, but not put a lot of weight to, primarily because it doesn't always get passed on to consumers. So their costs may go up, but it doesn't always get passed on to consumers, and what we gauge is more of the consumers, like our CPI and the PCE. This is also known as the PPI. Now, this is including the food and energy. So back in August, we had a 0.2% increase. Now, for the month of September, the forecast is supposed to be 0.4, and it came in at expectations. Now, if you strip out the food and energy, it actually came in at 0.2%. Now, this is year over year about 2.6% inflation, and then the core PPI comes in about 2.2%. So they both did go up a little bit, and it primarily went up due to the hurricanes. As hurricanes came in, if you see energy prices like gasoline and everything, they all went up a little bit as a result. So that's what we're kind of seeing, especially on the big number here of 0.4% increase. That's due to the energy prices rising. So let's go ahead and take a look here at the headline news. The stock market's down a little bit. We've been kind of closing at these new highs almost every single day. So pretty much when we got to the earnings reports today, we got the first batch coming out, with especially the big ones right now are the banks. You had Citibank and Chase coming in, showing better than expected earnings reports, which obviously is good for the stock market, but it's a lot of stuff's already priced in, and so far it's down a little bit, but it's just very modest, and this could quickly change during the course of the day. But again, it's just it might be kind of just running its course where it's taking a slight break or not. There's really no reason for it to be down, but again, part of it is, it's the optimism of the earnings reports that kept going up and up and up. Now it could be taking a little bit of a slight breather. We also have a lot of Fed speakers today. We had a couple came out talking about interest rates and such. We had one that said that doesn't necessarily, yesterday they said, doesn't necessarily mean that we're going to have a rate hike by end of the year. I believe that was Evans out of Chicago. But then we had another one saying that even if we do raise rates, the economy is strong enough to absorb that, basically. So, and that's kind of why the stock market ended the way it did yesterday on the upside. So they did like the comment that even though there's rate hikes coming, the economy is strong enough to absorb it. So they felt good that the Fed was confident on the resiliency of the current economy, or at least where the trajectory is going. So let's go ahead and see how this is affecting the bond market. And the bond market's doing quite well, actually. We're above, of course, pulling further away from the 200-day support. We're going in above this Fibonacci number. We're up currently about 13 basis points. So we're almost to the level where we were before the rollover. So again, we have to disregard this because this is a rollover. So actually, we would be probably closer up to here if it wasn't for the rollover. And again, we're up about 13 basis points, which translates into better pricing today for interest rates as a result. So as you can see, yesterday we kind of battled and pulled back. Today we kind of started falling down and we pulled back. So again, we could see a nice little reversal here and get a slight improvement in the near term here. All right, so in the meantime, again, prices improved a little bit today, and interest rates. So here's the 10-year Treasury. Speaking of such, we're still above the 200-year or 200-day moving average. We're going the sideways pattern. Again, as we see, we've tested it's pulled back. We've tested once here so far, and it's pulled back. So far, we're just keeping the sideways pattern. We probably will keep this for a little bit until we get some major break in one way or another, and that could be, if they ever announce the tax reform, that could break one way or the other. Most likely yields will probably go up as a result of that, as that would help the economy further and increase this stocks and probably worsen the mortgage-backed securities. But in the meantime, again, this is kind of going in a sideways pattern here. All right, folks, that pretty much wraps it up. I hope you guys have a wonderful rest of your day here. But if you guys want to get more updates throughout the day, just come over to Twitter, and you can find me under my handle, Mike Bjork. And I hope you guys enjoy the rest of your day. Thanks so much for watching. We'll see you guys tomorrow. Bye-bye.